I guess I don't have time to go.
No. Okay, good. He's going to wave me to get started in a minute.
We're first.
Good afternoon. I'm Alec Ellison, Vice Chairman of Jefferies and Chairman of our Technology Investment Banking practice, and I want to welcome you to our afternoon panel on venture capital and growth equity investing. We've assembled a very distinguished and highly successful panel of venture and growth equity investors focused generally on the technology and related markets. Let me introduce them briefly to you, although their more complete backgrounds are in the conference brochures. Moving from my left, Scott Sandell from New Enterprise Associates, Paul Maeder from Highland Capital Partners, Paul Barber from JMI Equity, Robert Smith from Vista Equity Partners, and Brett Rochkind from General Atlantic Partners. This afternoon we hope to provide a perspective on a range of topics, but our overall theme is going to be where are these investors placing their bets, and as importantly, where are they not placing their bets? How are they generating returns from their investments? We're going to try to be as specific as we can, naming perhaps more companies than you've heard in any other conference at the Milken event so far, most of which, of course, be private companies, but it'll give you a sense of future opportunities. Topics we hope to cover will include discussion of segments such as cloud computing, cybersecurity, e-commerce, big data, enterprise apps, social networks, and we'll also touch on different geographies. We'll also spend a few minutes on the state of the venture capital business itself as an asset class. Let me start with a few slides that are hopefully provocative to set the stage. Slide one, please. Move to the next slide. Two. Okay, these are three slides entitled Who's Eating Whose Lunch, which look at a variety of categories that have been fundamentally changed by the technology world. These are some familiar stories looking at the first four categories that are content categories, followed by three more distribution categories, and we've seen challengers really take it to a series of incumbents, and in fact you see some names on the left that are out of business now, in fact. Go to the next slide, please, number 3. These are some emerging stories that where the battle is still being waged. Broadcast advertising, for example, a $80 billion market where the incumbents certainly are not asleep at the switch. And we see the likes of Google, Facebook, Yahoo, and others going after that huge advertising spend. Other markets, banking, car rental. Here we actually saw one of the aspirants, Zipcar, acquired by Avis, one of the incumbents. The recruiting market, where LinkedIn is waging a very successful battle in a traditionally highly fragmented market. And the categories continue from there. Let me go to slide 4, please. And among technology vendors themselves, the changing platforms create opportunities for new challengers. So even the great leaders such as Oracle, SAP, Google, IBM, EMC, Microsoft need to be playing defense as well as offense in the face of the opportunities created for new aspirants. We go to slide 5. Now this is a slide along with the following one which actually created inspired the title, The Enterprise Strikes Back. What you see here is the IPO performance of the 10 largest enterprise technology firms on the top and the 10 largest consumer technology IPOs on the bottom. And quite a disparity, the group on the bottom being impacted by the likes of Zynga, Facebook, RenRen. And on the top, the enterprise firms not performing that well, but certainly much different than the consumer. And let's go to slide 6, please. And this is the same 10 consumer technology companies on the bottom. And here we see it contrasted with the largest 10 enterprise software companies, the likes of Workday, and Splunk and ServiceNow. And I should note, and these are not market-weighted slides. Every company counts as one. So a tremendous disparity in performance. So with that as a backdrop, let me start with you, Scott. NEA has been a lead investor on both sides of this consumer and enterprise dynamic, with investments such as Groupon on the consumer side and Workday, Fusion.io on the enterprise side. What's your perspective on this dynamic?
Well, I think what's clear when you get to see both sides of it is that one has enabled the other. if you think about it, the rise of Groupon and Amazon posed challenges to those companies and caused them to build new foundational technologies, which did a couple of things. One of which was they proved it could be done. So if you just take Google and search, for example, business intelligence, which is essentially what search is, has to yield a result in milliseconds. And prior to that, all the business intelligence solutions leading up to that time were happy to deliver a result in weeks or months from the IT department back to the business users. And so Google had to completely re-architect everything about their technology platform in order to deliver search. But when they did, they proved that it could be done. And so people started to study exactly how they did it. And what they saw was that when you're doing something at Google's scale, you have to have what's called a scale-out architecture. I'm sure most of you are familiar with it, as opposed to a scale-up architecture. It has to be infinitely scalable and very low cost. And you quickly see, if you were in their shoes, that none of the incumbent vendors, either processing, storage, or networking vendors, could deliver what they needed in terms of cost and scalability. And so Silicon Valley quickly got to work, and literally hundreds of startups have cropped up in every area of that infrastructure to deliver what Google did for itself to everybody else, because of course until recently Google hasn't made its underlying infrastructure available to other companies much the way Amazon has. Amazon of course is the second proof point of what's needed. And so we've seen, on the one hand, the infrastructure potential exposed by Google, and on the other hand, what we've seen is consumer technologies invade the enterprise. So, of course, the smartphone, which is only 6 years old, and the tablet have become incredibly popular devices that essentially employees bring to work and force their employers to deal with. And in the first wave of that invasion, IT departments are merely figuring out how to cope with security requirements and things like that. But at a more fundamental level, they've reset expectations of what technologies delivered from the IT department need to look like. And that, combined with the advent of cloud computing, I think has essentially broken everything in the enterprise. So that these startups, which saw the opportunity presented by Google, essentially have open field running in a way that we haven't seen in the enterprise in about 20 years.
Paul, Highland's been investing in both early stage consumer internet and enterprise tech for a while. Where are you currently focusing?
We have a stronger weighting towards enterprise software businesses. We've got about 30 software businesses, enterprise software companies in our portfolio. And on the consumer side, probably 10 or 15. And part of that is just a reflection of changing times. I think the phenomena that Scott talked about is really the manifestation of the development of technology. 30 years ago, there wasn't any consumer software to speak of, a consumer software market, because the technology just wasn't ready for consumers, couldn't do much for consumers. So when we talk about consumer software, we're really talking about internet consumer. And the venture industry grew up around investing in enterprise software. And we had a very clear formula. We'd find some people who can do something that nobody else can do, that provided a positive ROI to businesses. We then talk to the business buyers, and they tell us how to develop the product. We develop it, we sell it to them with a direct sales force, and the sales force would bring back additional feature requests, and we continue to evolve and grow the businesses. That dynamic doesn't exist at all in consumer internet. Consumer internet is a very, very different animal, and we're just adjusting to that. The former buyer, the enterprise buyer, is driven by ROI. They understand you need to make a profit. They're willing to work with you. They tolerate buggy software, at least initially. And consumers are fickle. They don't want to pay for the software. They don't want to pay for the product. They want to steal from you. They want to return the product and get a full refund if they just don't like it. And perhaps most importantly, they're driven by taste and fad, and there's no accounting for taste. So it's a much less predictable process for both funding and forming companies. And frankly, our industry's adjusting very rapidly to that.
Now, Paul, JMI has focused entirely on software at the outset. You've moved a little bit into internet since then, and you've been a major investor in software as a service as well.
Yeah, we come at the world from enterprise software. A number of us grew up at an investment bank, Alex Brown, in the 80s and 90s, and took Microsoft public and Oracle public and saw the opportunity for enterprise software. If it might make sense to pull up slide 19. And the theme that we're based around is that software is a bigger part of the economy. If you look at this it's dollars on the left axis and percent of GDP on the right axis, and just every year, software is it grows, and what we're trying to do are find markets that are growing and then the leading companies within those markets. And every decade or so, there's a platform shift. There was the mainframe era, there's the PC era, we're now in the cloud era. And so it creates opportunities to grab more dollars and then hopefully build better business models. So right now we think there's a big mega trend in the cloud that's a 10-year trend that's going to increase the percentage of GDP that software takes.
Robert, your firm Vista has taken a little different approach. You've focused also on software, but you seem to roll your sleeves up a little more than some others do and take a approach often buying perhaps slower growing companies and really making changes. Perhaps you can share with us your general approach.
Sure, and I would say initially slower growing companies.
Okay.
That's an important part of how we think about the distinction of who we are at Vista. Fundamentally, what's occurred in the software industry is that these companies have now created tremendous value for their customers. And over the last 10 years, 15 years, there's been a recognition that the customers are as reliant on the software vendors as the software vendors are on their customers. And what we do at Vista is basically re-examine that economic relationship. And we restructure that economic relationship. And we do it through a system that we've developed to deploy processes and solutions into our businesses so that we can then do a few things. One is create that partnership where there's a longer term relationship where we are adding value to our customers are adding value to us and our stakeholders. If you think about enterprise software today, I always use the old adage, if I lend you $1, it's your problem. If I lend you $1 million, it's my problem. That's really where the customers are today in enterprise software. You look at that list, all of those companies that you had, on both sides are completely reliant on their enterprise software businesses to do their work every single day across every industry. If you flip to slide 22, just to give you a sense, from Vista's perspective, we invest in companies that are across every industry. What you see is the largest software company here for upstream oil and gas, largest one for utilities, largest one for core bank management and treasury management software, largest one for automobile dealers, largest one for lab systems for hospitals, largest one for physician practice management, on and on and on. The thing is, every single industry out there is completely reliant on some enterprise software system. So what we do at Vista is reshape that economic relationship. We have a series of best practices that we drive in those businesses, and that has led to consistent results. Mm-hmm. If you think about it, we take, to some degree, I'll call it a manufacturing approach to delivering software to our customers. And over the last 13 years, we've now done well over 80 transactions with 0 losses. We've made money on every single buyout in 13 years.
So 80 in a row?
80 in a row.
I'll remind you, we're just down the street from UCLA, and they had the famous 88 in a row.
Oh, yeah.
And Bill Walton has been known to walk the floors of this conference, so if you see him, tell him Robert's chasing him.
That's it.
He's got 8 to go.
Tell him we got him.
Okay, yeah, 8 more to go. Brett, General Atlantic, let's turn to geography for a little bit. General Atlantic has been investing in technology for over 30 years and went international, I think, around 87, 88. And has now how many offices around the world?
11.
11 offices around the world. I just saw a new investment today in Brazil.
Yep.
And I think you're our one panelist who's actually lived in Asia. Is that correct? I think
Yep,
that's right.
Was there in Hong Kong. Yeah.
So perhaps you can provide a global perspective on this topic.
Yeah, definitely. I mean, as Alec mentioned, about half of what we do is in the U.S. and half is outside. And I'd say about half of where we've invested in technology has been in software and half has been internet. About $1.5 billion in the last kind of 5 years, enterprise software, and $1.5 billion in internet. Our perspective is we're big fans of growth. So if you look on the enterprise side, I think we completely agree with some of the comments Scott, Paul, and Paul have said about kind of where the enterprise landscape is going in terms of consumerization of IT, in terms of the move to cloud and SaaS. As a result, we think a convergence in both ways. We invested in a company called Box most recently and led their growth round. And we think that plays right into the middle of those trends. Big data, we see tremendous changes going on in that market. So we invested in a company called Mu Sigma, which is right in that sweet spot of helping enterprises deal with those challenges. And then the internet side, you can turn to slide 28. While everyone is, and maybe it's a contrarian view, although I don't think it's so contrarian, is very focused on enterprise technology, we just look at this chart and we say, global internet growth is going to be dramatic. It has been dramatic in the last 10 years. We think in the next 10 years, there's going to be 4 billion global internet users. We think most of those geographies will be, most of those new users will come in markets like China, in India, Brazil, Mexico, Indonesia. And so we think in many respects, if we can back great business models in those markets, and the next slide demonstrates some of that, slide 29, that we can really find the market leaders that are going to dominate in many respects those markets. And so we've been successful in many of the companies on those lists, investing in those companies. We love the concept of internet marketplace businesses, combining fragmented customers, fragmented suppliers, putting them together in the case of Alibaba Group, Mercado Libre, similar to how eBay did back in the late 90s. And so a lot of our focus is where is that puck going? Where is the global growth happening, both enterprise and internet? And we are pretty bullish on both markets, although obviously, I think we'll probably talk about on the panel, there is a lot of hype around some areas, and valuations have clearly increased quite a bit in that market, in the private market in particular.
Now, Scott, you lead NEA's efforts in China as well. Mm-hmm. And provide a perspective on the opportunities you're seeing in China currently.
Well, I think we would agree with the macro trends, which I think are creating tremendous opportunities for entrepreneurs. What we see in China is a little bit different than what we tend to invest in the United States. In the United States, we're looking more at fundamental innovation typically. In China, there's a little less fundamental innovation, but there is a huge growing market, and so entrepreneurs there tend to copy what's happened here, but they do it with a modification that uniquely makes them successful compared to their Western rivals who might come into China with an existing business like eBay famously did. Meg Whitman declared they were going to beat Taobao and spend $100 million doing it, and it didn't work out so well. But Meg, is not alone. I think there hasn't been an American company yet who has done well here and there. So we see a lot of opportunities for people who can take what has worked here and modify it there. I think at the same time, since I've been investing there a little over 10 years now.
How many trips now?
40 trips.
40.
Wow.
The innovation ecosystem has developed. A lot of people have gotten a lot of entrepreneurial experience and understand better today how to deliver products that are suitable for a world stage. So I would expect over the next decade or so that you'll see some big startups that come out of China, not just serving the China market, but doing something which actually makes an impact everywhere. We have one example in our portfolio, Aerohive. It's a little bit of a hybrid company. The CEO is in Silicon Valley, but all of the development for their next generation wireless mesh networking technology was all developed in Beijing. And they are crushing their competition here and everywhere else in the world. I think we're going to see more of that.
What percent of your fund is focused on China currently, or NEA overall?
Our allocation in our last 4 funds has been about 10%. Our funds are $2.5 billion, so $250 million a fund. Okay,
great. Now, Paul, staying on the geography theme, Paul's our one East Coaster, our token East Coaster on the panel here. And there's certainly been a little bit of a shift on the East Coast itself. Boston is being rivaled by New York somewhat in terms of receipt of dollars. It'd be interesting if you have a perspective on that.
Well, there has been a pretty massive shift over the last 5 or 6 years towards New York in terms of particularly consumer software, consumer internet software. I think that's going to reverse again over the next decade. And I think it's a phenomenon of some historical accidents, principally the 2008 crash. There's this biological imperative that young people seem to have when they get out of college to go to New York and spend 2 years partying and kind of mating and working unreasonable hours and partying unreasonable hours and not sleeping at all. And in 2008, the usual crop showed up and the crash occurred. And at the same time that these folks showed up for their investment banking jobs, the investment banks were laying off people. They were laying off IT people. And the advertising and marketing firms were all laying off people. And these people kind of looked at each other and said, let's start Union Square. And the upshot of that has been a lot of very interesting companies in a very, very creative environment with a very interesting geographic dynamic, which is walking, which is everything that's going on in New York is walking distance. And we took a group, we have a program called Summer at Highland where we allow college startups to apply to a summer program. We took them down to New York last year. We had about 18 companies, and we took them around to 11 companies in one day, all on foot, including a couple of incubators. And it's only in New York that you can do that. Now, having said that, in Boston, we noticed what was going on over the last decade. Before about 10 years ago, everybody moved out to 128 to be near the talent, the CEOs with experience, the VPs of engineering, the VPs of sales, and VPs of marketing with experience, because that's what you needed to build an enterprise software company. Well, that's changed recently with consumer internet. You don't really need a big engineering department to develop a piece of software that you put on the web with tools that you can develop overnight or over a weekend in a dorm room. You don't need a sales force because you put it up on the web, and if it sells, start a company. If it doesn't sell, develop a new product next weekend. You don't need a 20-year experienced marketing executive because, again, Google AdWords is your marketing team, and you don't need an experienced CEO. So all the venture firms in the Boston area have systematically moved back into Kendall Square to be around the universities, be around MIT and Harvard. Harvard's gotten very, very serious about their engineering department and has allocated between $500 million and $1 billion in their next capital campaign to growing their engineering effort. And there's something called Cambridge Innovation Center in our building that has 350 startups distributed among 7 floors in our building. So you can literally just feel the building shake with the entrepreneurship that's happening. Now there's always a time lag, and it's going to take 5 years until that shows real critical massive results. But some early indications are already out, and there are a lot of interesting things going on in Boston. So I think the answer is win-win. I think New York's going to be very vibrant for a long time, more consumer and marketing oriented, and Boston is coming back very, very strong with lots of things consistent with its heritage of systems, hardware, hybrid sorts of companies.
So Harvard noticed that a bunch of Harvard guys decided they had to go to the West Coast to build Facebook?
Yeah, they decided maybe that wasn't an outcome they wanted to repeat. Bill Gates and Mark Zuckerberg,
That's enough.
Yeah, exactly. That's enough.
Yeah, and as I think many know, in New York now, Cornell and Technion are building a great new technology center on Roosevelt Island that's now been funded with between $500 million of private donations and university donations. So it should really continue the trend on the consumer from the consumer more to the enterprise side that Paul has outlined.
And I was just speaking at an East Coast entrepreneurship conference held every year at Princeton, and that ecosystem is really starting to take off, and those people are all heading into New York. So I think it's all good.
Okay. I want to talk a little bit about SaaS versus enterprise software, the varying models. Paul and Robert, you've both been on both sides of this type of dynamic. And how do you think about investing in a company that might have a more traditional model versus a software as a service model? And why has the SaaS model come to really dominate the IPO world?
So I'll start. So JMI Equity, we've made 110 investments. We've sold 70 companies. We have 42 active companies, roughly half SaaS, half cloud, half non. There's a number of great businesses like Kronos that's here that have been around for 30 years that have great businesses, a lot like Robert's portfolio. A lot of those businesses are maintaining their core business and then either buying or developing a cloud product, and to be able to provide both. And then there are new startup companies that are trying to go replace those markets. So it might make sense to pull up slide 21. So what this slide tries to show is if you look at by category, where SaaS is penetrated. So on the far left is the CRM space, Salesforce.com, which is the largest SaaS company. They're a $25 billion market cap. They still have less than 40% of that vertical. And you can see across these verticals how low SaaS penetration is. So over time, we think SaaS is going to go displace, but then there are going to be high quality companies that develop their own or buy. So interesting, last year was the first year that the big three vendors, IBM, SAP, and Oracle, they bought more cloud companies than they did perpetual. And so you're going to continue to see this rising of SaaS vendors, and the existing vendors are going to have to buy or build to compete.
Now, there's a little difference in margin, right, Robert?
A little bit. I'll tell you, one of the things that's interesting.
You got to pull up slide 23 for Robert.
Okay, thanks. I mean, one of the things that's interesting in the way we think about it at Vista, we probably converted more businesses to SaaS than I think any company that I know of over the last 13 years. What we are doing, again, is fundamentally re-engaging our customers and changing the economic relationship. Many of our customers are indifferent to some extent as to how their software gets delivered. Some want it SaaS, some want on-premise or LAN, and we don't try to force them one way or another. We want to provide the option for them, and we want to do it at the lowest cost to us and create the highest value for them. This gets back to that relationship again. We get out of the dictating what exactly it is, the terms, and dictating exactly how you're going to take it, and dictating exactly what it is that you're going to receive into. Let's get into a relationship, and it's a long-term relationship. It's going to be a contractual relationship. We're going to build products that we can demonstrate to you have tremendous ROI to you as a customer. And as a result, we're going to benefit from it in terms of delivering those products at the lowest cost, which gives the graph that you see on the page. This is our entire portfolio over the last 13 years, every single company. It's time series analysis, so you start at the left side. On average, when we buy a software company, it's about a 16% EBITDA margin. 2 years after we own it, we've about doubled it. In 3 years, we've about tripled it. Okay, that all comes from realigning that economic relationship with the customer. And in some cases, they want to move to SaaS because it cuts their cost. That's great. Well, we have figured out a way to do it in a way that actually improves our margin and extends the relationship with that customer, because if you extend the relationship with your customer, not surprisingly, you have the ability to extract additional economic rent over long periods of time that you can then reinvest into the products, reinvest into the people, and drive that business across what I call multiple areas for that customer's needs. So when we think about some of the startups that we see, we call those add-ons. Because ultimately, many of those products are very beneficial to our customer, and it takes a while to get traction in an enterprise software space in order to get enough customers, to get enough revenue, to actually support your development organization, to support your services organization. And those are the sorts of businesses that when we bolt onto our platforms, give us tremendous economic pickup from an EBITDA perspective, and then of course we get top line growth.
Does it become hard to take those kind of companies public, though, that perhaps you don't want competitors or your customers even to see those margins?
It is a good question. It is interesting. We have never taken a company public because when you're driving businesses at 40, 50, 60% EBITDA margin and you're asking your customer for a modest 5% increase in their pricing,
they waive that prospectus.
It could be a little challenging for you. All that said, we have 3 companies in our portfolio right now that will likely go public. Mises being the largest of them, SumTotal being another. And these are businesses that provide tremendous value to their customers. Many of these have over 97% retention rates with our customer base. The customers rely on them. They rely on us to build them products that give them high ROI. And as a result of that, they are looking for us just to be a partner in the relationship over a long period of time as opposed to just a vendor. That's the difference in the way that we manage our business. And we don't care if it's SaaS or if it's LAN, and many of our customers don't. And if they do, we'll offer it in either flavor.
Any other comments or reactions on this dynamic, SaaS versus traditional model?
Personally, I think we're in the middle of a transition, and I think it'll probably take quite a long time. So I think there's plenty of time to move to a SaaS model, but the inherent virtues of the SaaS platform from a speed of development perspective, having one code base that's delivered to all the customers, and ultimately being able to advance your feature set faster will cause that model to win in the end. It will not be as profitable as Robert's companies anytime soon because the customers don't pay you up front as they do with a perpetual model. But nevertheless, we've been involved in the SaaS revolution from very early days. I invested in WebEx and then Salesforce, which I thought of as kind of generation 1.0 SaaS companies. And what they did really was they took the existing infrastructure, off-the-shelf technologies, Oracle's database, web servers, and the like, and they built a relatively lightweight application on top of it. I remember the first day, Mark Benioff took me around Salesforce to show me the lab and the company and the employees, and he pointed to this little pod of developers. There were 8 of them, and he said, that's my entire engineering team. They were doing $20 million in revenue at the time. So it was not, to begin with, a hugely heavyweight application. Obviously, he's done wonderful things building from there. But I think if you look at the more modern SaaS companies, Workday would be a good example. They didn't just take off-the-shelf technology. They essentially built from bare metal up. And what most people don't understand about Workday is they have a completely object-oriented model that lives in main memory. And the result of that is they can develop new functionality about 10 times as fast as a traditional developer, a traditional application company. So I think that's going to be very hard to compete with over the long run.
But it is a big challenge for venture firms. It's a little like what Tony Blair said earlier about the UK being part of the EU made all the sense in the world politically, but joining their currency made no sense economically. This makes all the sense in the world for how you develop software and how you deploy it, how you maintain it, and how you provide real value to customers. The challenge is you're taking big companies who are the customers, who have a very low cost of capital, and we're essentially financing them by renting them software. And that's a difficult economic model because it requires more capital on the part of venture firms, unless you can technically get over some of the challenges around developing this big piece of code and then getting trickles of revenue for it. And some of the tools that are in use today and some of the techniques have helped to some degree with that, but it's nevertheless a challenge for the funders.
So Paul,
well, it's a good thing that they need capital, though, Paul. Otherwise, we'd be out of business.
It's a very good thing.
Yeah, pull up slide 16. I want to come
No
back
complaints.
to, I'll call it the other side of it, 16 if you could, which I think is one of yours, Scott, correct?
Yeah.
And this is really the capital efficiency in the other side of the market.
Yeah, I mean, I think this is actually applies to a broader point, which is that what excites us so much about investing in new companies today versus any time in the last 20 years is 3 things. One, you have enormous numbers, 10 times the number of broadband users worldwide that we had in 2000 when companies were trying to acquire customers and spending a lot more money because there were fewer of them to access, and the emerging markets are a big part of that. Secondly, you have what's shown here, and that is that the maturation of the technology stack enables people to create things with very little capital that they couldn't create before. Probably the best way to understand it, since frankly the left-hand part of this, the building blocks chart, looks similar to what it might have looked like 10 years ago. But if you look at the chart on the right, it displays the number of APIs that are available to developers. And API is essentially a programming interface that allows you to access functionality that lives somewhere else in the cloud, that's provided by a vendor that might just do payments, or they might just do some other function that you need. And so the ability to access those things means you don't have to build them yourselves. And you can see from that chart that the number of APIs is growing extremely fast. So people can develop things much more cheaply than before. And then lastly, as was already mentioned, the cost of customer acquisition has fallen precipitously as well. And so a new business model has emerged, which Paul alluded to a little bit, which we think of as the freemium model. That's the industry term for it. Basically, if you have a very low cost of delivering service to a customer, you can offer that service for free and upsell those customers to some paying model, typically where only a small percentage of them are paying, but the economics work out extremely well. Box was alluded to earlier. It's another one of our portfolio companies, Dropbox. These companies monetize. Box is a little different, but Dropbox only charges 3% of their users. I mean, I only started paying a subscription recently, and I've been using it for years.
I also think capital efficiency is a choice. I mean, we built ServiceNow with $7 million of venture capital.
And what's the market cap now?
It's over $5 billion. And I think that the Valley often overfunds businesses. They spend too much money too early. And we try to take more of a Navy SEALs approach where you get a small number of developers who build a product and go out in a cost-efficient way and get a small number of customers and then let customers fund. And there's a trade-off. But capital efficiency, I think one of the issues for venture returns has been a lack of capital efficiency. And it can be a choice. And there are examples like ServiceNow where they're quite capital efficient.
Mm-hmm. It's a crazy, the venture model is really crazy. You invest in a company and you may buy 20-25% of the company for $2 or $3 or $4 million in a Series A. And then you get to keep rebuying your 20 or 25% round after round after round. You keep putting in money, your ownership doesn't go up. And so people have kind of started to notice that and become more and more concerned about capital efficiency. At the same time, we've gone to more SaaS models where it's absolutely necessary to be capital efficient for the reasons I mentioned.
Because you're having to fund your
Because you're having to fund your customers, you're financing your customers, and at the same time that those building blocks that Scott mentioned have come along and made software development way more efficient. I got in the venture business in '84, and when we funded a startup to develop a software product, on-time development performance was kind of a joke. If we thought it would take a year, if the management team said it would take a year to develop a product, we figured it would take 2 years. If they said it would take 3 million, we'd be lucky if it took 8 million. You were kind of hoping that each board meeting, the time that the product would be done didn't extend further and further and further. And now it's rare that a software development project doesn't come in on time and on budget.
Well, Paul, to your point, I don't think all of us Valley venture capitalists are entirely irrational. If you could pull up chart 15 for a second.
Does that mean most of you are partially irrational?
Well, I mean, look, we have some companies. Workday has used a huge amount of capital, and I think it's going to work out extremely well.
Yep.
And then there are other companies that I can't talk about, but you'll see in the public market very soon that make your $7 million look generous. So we'll leave it at that, Paul.
Okay.
But this is the problem right here. This is the new capital commitments to the industry in the United States over the last 20 years or so. And obviously what you see is this gigantic bubble in 2000. So most of us got in the industry in the mid-90s. By the way, these numbers are all adjusted for inflation to 2011 dollars in case they don't match up with your personal recollections. Like 1996 is actually $10 billion, but adjusted for inflation, $17 billion. Anyway, that $135 billion that flowed in at the beginning of the last decade caused a lot of very aberrant behavior, because logical entrepreneurs would go to market with an idea, and instead of 4 or 5 good teams coming to market, there'd be 25 or 30. And when you have 25 or 30 competitors, you do things in a very different way. You spend money to try to get ahead of them, and that leads to tremendous capital inefficiency. So I personally think one of the reasons that it's such a great time in our industry is that we're back to mid-1990s levels of investment in the industry. So we don't see 25 or 30 competitors pursuing each novel and exciting idea.
I think also, I just comment on the capital efficiency point. Every investment we look at, much like I'm sure you guys look at, is you look at the ROI to the customer, to Robert's point, around and to the company, and defining that relationship. The software business model, as we all know, is incredibly profitable. Even in the SaaS model, when you take away when you factor for the customer cohort analysis, when you look at the cost of acquisition over a long-term period of time, if you manage churn effectively, it's actually a very profitable endeavor when you deploy capital against that idea. And so I think we look at it and we kind of say, capital inefficiency in some respects creates an opportunity for us as a later stage firm, because we can invest $50, $100, $200 million in companies. That said, we very much like profitable business models, and my first investment was a company called SSA Global, which is still around as part of Infor, and it was basically playing on the fact that there was this bubble in the environment that created great technology, and there was a chance to acquire that technology and build a real business around it that created great cash flow, almost $200 million of cash flow. So I think the way we look at it is, there's a great time to be in the market. As Alec said in some of the earlier charts, public values have been pretty high. Private market values have been pretty high. I don't know what other people's thoughts are, but the challenge that we've seen is we don't see, unlike the consumer market where you had public market correction, and there wasn't necessarily a strategic buyer. Obviously Groupon had discussions with Google before they went public. There hasn't been someone that's come up to swoop it up now in the public market. You don't see Zynga necessarily being acquired. In the enterprise space, you do. because you've got a group of acquirers. SAP and Oracle have obviously been most active. IBM, Cisco will probably need to get more active like they were historically. And that in many ways is kind of supporting values both in the private markets and the public markets, which creates opportunities for our existing portfolio companies from a new capital perspective. Does cause a bit of a challenge in figuring out when is the right time to invest. How do you factor that into your analysis and get into good investments and good deals?
Brett, GA has continued to invest in e-commerce, which we're all heavy users of in our current lifestyles, not just overseas but domestically. I think you're in Gilt as an example. I think there's a lot of debate about the future of e-commerce. Is the Amazon juggernaut basically going to consume any promising category, or can you really have a niche or slightly larger than niche play? What do our panelists think about that opportunity?
Yeah, I'd address it first. I mean, I think most of our investments, when we look at e-commerce, and because we're very business model focused, most of our bets have been marketplaces, like I mentioned earlier. I think that, even though Amazon has obviously been incredibly successful, created great customer value and shareholder value now to date, if you look at the actual cumulative cash flow of Amazon to date, eBay dwarfs that almost in a year. At least, if last couple of years might change that dynamic, but at least in the first 15 years of Amazon's existence. And so our perspective, if we look at it, is markets like China, where you have Alibaba so dominant and also being foreseen by consumers as the Amazon-like solution. They have the best selection, best convenience, shipping is darn good, and comparable to any good competitor. That's a market where they are dominating both from a customer satisfaction perspective, but they're also dominating from a profitability and cash flow perspective. Much like you look at Apple's percentage of profits in the smartphone industry, that's what eBay has, and that's what Alibaba has in the China market. When you look at more traditional fulfillment-based e-commerce models, and one of them, as you referenced, is Gilt, that is a tougher market. I think you have to have a special relationship with your consumers. What Gilt's done really well is develop that relationship with some very elite consumers. I don't know if any in the audience are, or either yourself or your wives are Gilt customers, but they have a loyal following. And people at noon every day get an email, they still do, and they're buying, in some cases, $100 of goods, $1,000 of goods, in some cases even $100,000 of goods. And that creates a really good, loyal, recurring business. Actually, Gilt is profitable. And so it's one of those businesses that we think is a bit unique. Clearly, I think overall our thesis is Amazon is quite dominant in the U.S. e-commerce market. We've passed on most other investments. Gilt, we think, is in a neat position.
Robert,
I'll tell you, Alec, and Britt makes some really good points on e-commerce. The way we think about it is e-commerce to the enterprise. Okay, again, the consumer is fickle. We don't know what they're going to buy from one day to the next, and if they're going to buy it, the next day and for a week or a month at a time or whatever it might be. But our customers typically are looking for some way to enable themselves to reach their consumers. And often they don't have what I'll call the IT infrastructure or wherewithal to develop some e-commerce engine that can enable their businesses. So part of what we do is the value proposition to our customers is we will enable you to reach your customers. And we will do it so it's fully integrated into your enterprise platform in a way that you can now sell your goods and services in the most efficient manner possible, which might be some browser-based or mobile-based e-commerce solution. So that's the approach we take, and that's a way that we can fundamentally go to our customers and say, oh, guess what? Let us be a more important business relationship partner with you, as opposed to you going to find some third party or some startup to try to create some interface to our e-commerce, to our solution, which basically dominates the rest of your enterprise. Mm-hmm. For us, it's a way to sign very long-term, very profitable contracts. It extends relationship within that enterprise for multiple years, and you have a way to actually value exactly what it is that you bring to them, and of course, price against it.
But you're steering clear of the fickle consumer with your approach.
Well, we let our customers handle the fickle consumer. What we do is help our customers reach them.
But I think there's tons of open field to run in e-commerce, and Amazon doesn't displace that. We've got a company in New York called Rent the Runway that takes $1,000 and $1,500 really nice designer dresses and rents them to women for $100, $120. They come in a nice box with a nice ribbon, and if you rent one, you get the size you ordered and another size off in case you slightly misjudge, so you don't miss your event. In an age where every time a young woman goes to an event, she gets photographed 30 times with iPhones, and that photograph goes on Facebook, and she can't possibly wear that dress again. renting these kinds of dresses makes a lot more sense than buying them.
Sounds good for guilt as well.
Yeah. That's the kind of model. It's logistics intensive. There are all kinds of peculiarities to it that Amazon would never touch. 10 years ago, we were lamenting the transformation of the American economy from products to services. Really, e-commerce has not touched services nearly as much as it has products and merchandising. And there are a lot of opportunities on the service side in e-commerce. So I think we're still in the early days, despite Amazon's dominance of innovation in e-commerce.
Great. I want to change tack slightly here and get a reaction to a couple of assertions. First, relating to security, which is a big topic, and I think yesterday in one of the panels there was discussion that the potential war between America and China would be a cyber war, not a physical war. So if one of the most likely black swan or so-called unknown events would be from a major cybersecurity crisis, is investing in security like buying a well out of the money put at a very low price that could pay off very well?
I don't think it's that simple, Alec, because I think the technology is moving really quickly. I think that the basic landscape is that both the U.S. and the Chinese government have invested very heavily in both offensive and defensive capabilities. And the vulnerability here is that those capabilities, the defensive ones, are really not in the commercial infrastructure. They're only in the government-controlled infrastructure, which is why you've seen the government of late make make a lot of noise about this. They're trying to, I think, get all of us in the commercial sector to pay attention to the threat and start to adopt the kinds of technologies which might mitigate that threat, which are technologies that didn't exist 10 years ago. 10 or 15 years ago, security was also a fairly vibrant space. People deployed different strategies to defend themselves, which are frankly pretty obsolete today. And so the vulnerability exists because some of these newer technologies have not really been widely deployed. But as I started with, they're all evolving so quickly that it's not so easy to just go out and place a few bets. I think like anything in software or high technology, you have to find the people who are really on the front edge and who are going to stay ahead and innovate in ways that will be useful to their customers.
Yeah, it is a never-ending war. And in terms of every one of our customers, ultimately, they have that threat. Certain of those, call it security technologies we bring as an enterprise vendor, and many we have to just create an opportunity for, best of breed to always get plugged in and to manage across their stack. There is no solution that will last forever. And so the key is to just make sure any enterprise software business or solution we build has the ability to continue to evolve, to bring in the ever increasing, security dampeners, because that's all they are. They're dampeners. They're not going to prevent it, but they will dampen it for some period of time. So part of our job, and part of our jobs collectively, is to continue to keep our eye on it, make the right sort of investments that enable our customers to maintain safe data, keep their stack safe, and frankly, give them the ability to constantly evolve against this constantly evolving threat.
I think your basic premise is right on the money. It is. I'm an investor in a company called Bit9 that does endpoint security. Richard Clark, the anti-terrorism czar under several presidents, is on our board. It is, and I don't have a security clearance. It is frightening the things I hear at those board meetings that are going on right now. Research institutions in the United States being penetrated by foreign governments for 6 months before we know what's going on, and we are in the top of the first inning in this war. Mm-hmm. You thought the lights going out at the Super Bowl were a big deal? I'm from Boston. We just had to spend a day indoors because a couple of kids were throwing around, pipe bombs. Wait until the lights go out in New York for 24 hours. Wait till the subway system stops working. Wait till the traffic lights stop working. Wait till some power plants go down. It is absolutely the front line it's going to be the front line of warfare. And when somebody else starts developing drones and we have drones attacking each other overhead and they start getting hacked, it's going to be a very messy physical war as well. So I think this is a big area. The trick is, it really is best of breed. This is not like most markets where you have 3 competitors and you can make money on pretty much even investing in number 3. Nobody's going for one size fits all in security. They have to buy best of breed. So you have to back the absolute best teams.
One more statement to react to before we go to our lightning round. So form factor changes such as the smartphone, tablets always create opportunities up and down the computing stack, from telecom to hardware to infrastructure software to the application. So what I want to ask our panelists, the next big form factor change will come from blank.
It'll come from graphene.
Graph.
Yeah, graphene, which is single molecule thick carbon, which has higher conductivity than any material known, higher strength than any material known, and it in the next 5 years, people will be able, and very, very flexible, people will be able to start using it for circuitry, and will allow embedding microprocessors and intelligence in absolutely everything we have. But it's been happening in universities for the last 6 years. There have been no commercial products yet. There have been some very interesting breakthroughs in the last couple of months, and it's not going to start hitting commercial products for another 5 years, but it'll change our children's lives.
Any votes for Google Glasses as a platform similar to tablets?
It's a good marketing platform.
Yeah.
For some venture funds.
I just got to use one that a friend had last weekend. I think they will be popular.
Yeah, I think they will.
They work really well.
Good. Let's go to our lightning round. I want each of our panelists to tell us one or two companies in their portfolio we should have on our radar. And some of these may be available on Shares Post or on Second Market, even though they're not public yet. Go ahead, Scott, start with you.
It's always hard to pick,
I know,
favorites out.
yeah.
But two that I think have achieved a certain scale but are still off the radar, which makes them maybe interesting candidates, would be Cloudflare and Coursera. Cloudflare, how many people in the room have ever heard of Cloudflare? I see a couple of hands going up, but not many. It's the fourth biggest property on the internet today, but it's not visible to consumers because it essentially protects websites. They started out with the mission of protecting websites precisely because of this rising security threat, and recognizing that small websites would be the least capable of defending themselves. So it's a cloud-based network in a couple of dozen data centers around the world, and you send all of your inbound web traffic to Cloudflare, and they filter out all the bad guys, and they send you back only good traffic. They today have well over 1/3 of global internet users going through their network on a monthly basis. They have over 500,000 websites, and as I started with, they're the fourth largest property in terms of page views and growing very rapidly. This is an interesting example, by the way, of this freemium model, because the service is free. It also has the advantage of accelerating the performance of your website, which people like, especially if you're a mobile user. And so it's growing. They've never spent a dime on marketing. They've never spent any resources on sales other than picking up the phone. And of course they have, like all these freemium models, they have services you can pay for. And so typically the bigger companies will pay for their services, and some of their customers are sovereign governments. So there are very few entities on the internet today that can protect themselves better than Cloudflare. There was a recent example of this. Many of you will have seen in the New York Times a couple of weeks ago. One of the largest denial of service attacks ever brought about was between two spamming companies in Europe. And after fierce battle between these two companies, one of them decided to become a Cloudflare customer. Cloudflare has to be agnostic in order to provide the best services, so they will protect anybody that wants to be a customer. So they protected one of these against the other, and that was the end of the battle. But the truth of the matter is, hearing later about it, the magnitude and sophistication of these attacks is going up monthly. And that particular one almost crushed the internet, the whole thing, shut it down. And the only good news about that is that the people who run the infrastructure of the internet understood what could have happened and have worked very hard to remedy a lot of things in the infrastructure, which frankly were problems they should have dealt with earlier. So that's the good news out of that story. That's one of those companies, Alec. Second company is called Coursera. This is quick. Yeah. Sorry. Well, they're exciting. Alec.
I know. But I got the clock.
People are interested. All right, because Coursera, I won't say too much about it. It's a highly visible company, but it only started over a year ago. They offer online higher education. Came out of Stanford with 2 professors. They have over 3 million students enrolled today, over 200 classes online from 62 of the top 100 universities in the world.
Paul?
I'll mention two companies that I'm taking public next year. One is Imprivata, the other is 2U. Imprivata is software, a variety of software into the healthcare market. It's one of the biggest and fastest growing pure play healthcare IT companies out there. Imprivata is right at the core of the perfect storm that's coming along with the Affordable Care Act of making healthcare more efficient, more cost effectively delivered. Second is 2U, which enables also an online education, enables universities to take their entire master's programs, puts them online, not just lectures, but sections, office hours, group projects, everything. And we have exclusive relationships with universities, full tuition, same degree, 10 times the enrollment. Universities absolutely love it, redefining what a university is, both economically and in terms of their mission.
Paul?
One public company, ServiceNow, that's in the IT cloud space. One private company, DriveCam. If you get in a taxi or a limo and there's a camera, they sell a service that basically helps lower insurance for self-insured drivers drive safer because they don't want the camera. We invested in it as a hardware company and flipped it into a cloud software company. Every fleet in the country should have DriveCam cameras because drivers drive safer, so they lower accidents.
Terrific. Robert?
I'm going to go with, first one is Mises. Mises is the largest core banking treasury management software company on the planet. We have the top 50 banks on the planet. We have all 50 as customers. It's a company we have taken private and merged it with the Condor business of Thomson Reuters. It's a business that is going to do phenomenally well for us. Another sum total, learning management and talent management, and that's a company we're looking at probably taking public sometime next year. And one of the biggest battles that most corporations and CEOs have is how do they manage their talent, how they develop the talent, how they find their talent. And that is an area that's going to be of increasing focus as our economies start to emerge. And then lastly, Big Machines, one we share together, which is growing 85% top line growth year over year. So those are the three. Well, 2.5. You get half of the one.
Okay. I'll just stick with two. One in the enterprise cloud space, Aperio basically plays around all the success that Workday, ServiceNow, Salesforce is actually creating the ecosystem. What we're trying to do is disrupt the $300 billion system integration model. They've got a combination of professional services and crowdsourcing with over 200,000 developers right now that are in their ecosystem that help on engagements and deploying these solutions. And the second one is a company called Decolar, which is basically synonymous with travel down in Latin America, effectively the Priceline or Expedia of that market, although they've really created interesting localization in that market to deal with installment payments, vacation packages. Many of their customers are first-time travelers, first time on a plane, first time in a hotel, and really playing on the growth of the consumer in Latin America.
Great. Do we have time for one question from the audience? Go ahead, right here.
Can you guys talk a little bit about, if I give you a theoretical company, $400 million in revenue, a couple thousand employees, enterprise software application, what's an exit for a company like that, right? Because there's only so many companies that Cisco can buy, that SAP can buy. A $400 million company going public is not a particularly good public company. You see situations like Lawson or JDA where they end up going private again. So how many companies do you have, or what are the exit strategies for companies of those size? Do you bolt them on to other enterprise software applications to try to take them out to the public markets, or what's the exit?
So the question is, what's the exit for a $400 million software company, of which there are a few buyers?
Hire Jefferies.
Yeah,
Robert Bye.
Thank you,
No,
Paul.
the right answer is hire Jefferies so they can sell the business to us.
Robert's taken quite a few of those. I'm getting the signal we've run out of time. I know our panelists will be up here for a few more minutes. I want to thank you for joining us, and I want to reinforce a point that Scott made. Scott's actually incoming chair of the National Venture Capital Association, and Paul is a former chair. You saw that chart of the bubble 10 years ago and the amount of money going into venture, which has been much less. And as we all know, contrarian asset categories are often where you want to be focusing. So again, I want to thank our panelists, and thank you for your attention.
Yeah.